Okay, so the normal order here is trend, patterns, and momentum. Um, so we're taking a little out of order. The trend concept is the easiest, and I have to talk a little bit about that to talk about patterns. Um, Here we have an uptrend, and this is one way that an uptrend can reverse. This is another way an uptrend can reverse. You've heard about a head and shoulders pattern, and this is a head and shoulders pattern. Basically, what happens is stock has been in an uptrend, has a reaction that breaks an uptrend line but doesn't violate a support level. So we call that becomes a neckline. That's what we call it. Then we have a failing rally, and then a violation of support. So the steps in reversing the uptrend to end up looking like a head and shoulders pattern. We have a strong rally followed by a surprisingly big sell-off, considering how long this trend has been up, but it doesn't break support. Then we have a failing rally and a violation of support, and you often get a rally back to that breakdown point. Sometimes the process is more drawn out. Here we have an uptrend that's broken. Support is not violated. We get a weaker rally. We break another uptrend line, actually, but still hold support. Finally have a weaker rally, and then we ultimately top out. So here the process is a weaker rally, break of a trend, then violation of support, failing rally. Support violation. Most of the time, no matter what the pattern ends up looking like, we're going to go through this kind of process where we get a weaker rally, you break an uptrend line or two, then we have a failing rally, and then we have a violation of support. So the trend doesn't actually change till you break a support level. The definition of an uptrend is a higher high and a higher low. So once we have a lower high and a lower low, the trend has changed. So these are reversal patterns, right? We're going from an uptrend to a downtrend. And the basic difference between a continuation pattern and a reversal pattern is its size. If a stock is in a dynamic trend, it's not going to stop trending very long. If a stock has been in an uptrend for a long time, it's probably going to take quite a while to top it out. And so the basic difference between a reversal pattern and a continuation pattern is its size. It takes months for this kind of pattern to form. Continuation patterns rarely last more than a few weeks. There are many different nuances on all of this, but that's the basic difference. People see head and shoulders patterns all the time. There's two kinds of people, actually. Those that see them all the time and those that never see them. We look at that pattern. I drew it, this is exactly a perfect head and shoulders, right? We have several reactions at the same level. We have a couple of shoulders pretty much the same. And there are going to be people that look at that and say, well, I don't know, this shoulder looks a little higher, so it's not a head and shoulders pattern, I guess. There's also volume associated with this pattern. We're going to go back and start at the beginning again, but a head and shoulders pattern will have a head and shoulders top or a head and shoulders pattern will have that kind of volume profile. The biggest volume on the left shoulder, declining volume into the final high, lower volume yet at the left shoulder. In fact, the tip-off to this pattern may be becoming a top is that you have less volume on this rally than we did on this one. That's a tip-off that a head and shoulders pattern or a reversal pattern or a top might be forthcoming. However, and this is important, that's not a head and shoulders pattern. It looks like it might become one, but it's not one. It isn't one until it breaks down. So you can't anticipate a reversal pattern, right? I mean, yeah, if you owned a lot of this stock, you see this failing rally in here, well, you're going to be paying a lot more attention maybe, but it's not a top because, why not? Could evolve into some kind of consolidation. So when we're talking about patterns, we're talking about completed patterns. When you get good at this sort of thing, you might want to start anticipating them, but until it breaks, it isn't a head and shoulders pattern. It isn't the top. This is not a head and shoulders pattern either, because if it's it can't be a top unless there's been an advance. Right? It's a downside reversal pattern, a head and shoulders pattern. There's nothing to reverse here. The side's maybe been going sideways, or maybe it's come down a bit. But if it's a top or a head and shoulders top, it has to have had something to reverse. Okay. So you can't have a top without having an advance, and of course all of this is true in reverse as well. An inverse head and shoulders pattern is obviously a bottom, but you have had to have had a decline for it to be a potential bottom. And again, you have a reaction. A reaction that doesn't get down to a previous low, it's a sign of some strengthening, and then we break out to a resistance level and complete the pattern. The volume profile is not exactly the same on a head and shoulders bottom as it would be on a top. The ideal pattern would be volume rising through. Yes.
When would you consider the head and shoulders pattern? Say you clearly found the head and shoulders, and then you found the support. When you're trading, where would you say? Okay,
This is not a pattern that you're going to be able to trade from. This is a major reversal pattern that takes many weeks, usually months, to form. So.
But say you've identified it. You're up to where you're getting ready to make the trade. You're at the tail end of it, and intraday, you're like 5 cents away from where you deem the support level to be.
This pattern means nothing over 5 minutes intraday. Okay? That doesn't mean that it might not be additional information in trying to trade it, but you can't trade a head and shoulders pattern because this is day one here. It's at resistance. Day two, it closes up here. Somewhere, that's what's happening during that day of the breakout. You want to anticipate the breakout? Fine. You're going to need other reasons to buy it, though, because it's not a head and shoulders pattern until it breaks out.
So you're looking at the daily chart.
Mm-hmm.
You're doing analysis on the daily, but on the day of it looking like it's going to go through, you watch, and it starts to trade through that level. Do you say it's broken out after 5 cents through your support, or do you have to wait? How far through does it need to go through the support to say, all right, I think I have confidence?
Guess what? It's anything you want it to be. Okay? You have to decide. Some people will say, I don't think the pattern is complete until it trades 2 days above the breakout point. 2 closes above the breakout. Somebody else might say it has to be 2%. So you decide. Whatever there's no magic formula, and as long as you're applying some discipline over time and you're consistent, it really doesn't matter. And it doesn't matter. We don't have to catch it on that day either, because here we go. Let's just put the bottom in there again. So we've broken a downtrend, and we have started a new uptrend. There's almost always a throwback rally to the breakout point. It's a very, very common pattern that, yes, you missed it here, or this was very quick, but over time, and again, since this is months here, it could take a couple of months for that correction to be completed, and it might correct to that new trend line without going down. That's we'll get to that. That's sort of a tight consolidation pattern, and that would be a sign of relative strength where it has corrected without going down. What is a correction? We studied the glossary, but a correction is a movement in the opposite direction of the trend. This is a correction. These are both sort of corrections, and this is a correction. Correction is a movement opposite to the trend. So how we correct and moving. Let's do this overboard. We've studied what overbought and oversold means. Oversold means the lower parameter of the trend. And so this is oversold, this is oversold, this is oversold. Overbought is the upper parameter of the trend. So this is overbought, this is overbought, this is overbought. Weak stock can get overbought by going sideways. Strong stock can get oversold by going sideways. And it's sort of getting a bit sidetracked, but when we start with a major reversal pattern, we're going to have to make judgments about precisely when to buy if you're a trader based on lots of other things. We're going to be motivated by changes in intraday volume and volatility, and all the patterns are associated with those things. So let's look at that. I think the text basically starts with reversal patterns and then gets to continuation patterns. It really doesn't matter, but so when we're looking for a reversal pattern, prerequisite number one is there must be something to reverse. So if you see a head and shoulders pattern, that means that pattern must have followed a lengthy advance. All right, the text starts with a double top. What's the difference between a double top and a head and shoulders pattern? Not much, really. We have this is stock that's been in an uptrend. Doesn't show it on the chart, but it's been in an uptrend. Stalls at is this a resistance point? No, it's a potential resistance point. It's the first peak in an advance. We get a setback. Is this a support point? No, not yet. Potential area support. So we have an uptrend and a reaction in an uptrend. Now we have a rally that fails to get through a previous peak. So now, at this point, we know that there is some resistance of consequence at that point because we turn down from it again. In this case, we have a double top because both highs are at the same level. All the other rules apply. You have to break a support level to complete the pattern. So at this point, this breakout, or a lot of people call breakouts on the upside and breakdowns on the downside, but breaking out of the pattern is a breakout. And here we get a throwback rally, pullback rally to the breakdown point, and now we're beginning a new decline. So a double top simply means that we have a high and another high in the same area, and the intervening low is taken out. At that point, we have a top. The volume profile, which is not here, will probably also be diminishing. Higher here, not as high here. A tip-off and frequently another pickup when you break down. So the volume profile will be strong, and maybe it picks up here, maybe it doesn't, but you'll almost always have less volume at this rally. It would be most unusual for volume on this leg to be more than on this leg. In fact, if it was heavy, I'd be looking for it to go through for sure. So it's a double top, nothing magic. It just means two highs were in the same area, and the intervening support level is broken. That's what makes it a double top. On these reversal patterns, you've been long this stock for a long period of time. You've made a lot of money. This reaction was a little disconcerting to you maybe because it was bigger than you were expecting. So maybe in here you're going to be more cautious now. But maybe this wasn't a big reaction. Maybe the stock came from down here somewhere. But once we falter for a while and then turn down from that resistance point, now I'm changing my attitude toward the stock. I've been a buyer, I've been a holder of the stock, and now I'm thinking, well, maybe I need to consider selling the stock, certainly monitoring it more closely. All right, and it goes down quickly. We don't get an opportunity to sell it. It breaks down. So you might want to sell some on the breakdown. I mean, if I had a lot of profit over a long period of time, definitely do some selling on the breakdown if I hadn't done any before. Often you'll get this throwback rally and another opportunity. Often long stock should be sold here, short stock should be sold here. So, I would never be a short seller on a breakdown point, but on a throwback rally, especially after it's rolled over, now it's something that you want to consider shorting. Where some distance away from that peak, because this is my stop point. If I'm going to short the stock, I'm going to put a stop in here. So I need to see some decline from that resistance level. So that'll become my stop on the short side. This price was my stop on a long position, which was taken out. Okay, this is a rectangle only because we have a series of support and resistance levels that are approximately the same level. Now, a rectangle can be a continuation pattern. It can be a reversal pattern. The difference is going to be the size. If this is 6 months after a couple of years of advance, I'd be thinking that might not be a consolidation. But the point is, it's been trending. It has stopped trending. All we know is that at this point that this is some kind of pause in an advance. Do I want to sell the stock? Well, let's just say we've been in it, and right here it looks like the same as the double top pattern at this point. But I'm looking for support here, right? That's where it held the last time it went down. So I'm going to look for support there. I'm not going to look for a break of it. I'm going to look for it to function. If it breaks, then we have a double top. So it holds and rallies again. During this leg of advance, I'm going to be looking at the volatility and the volume to try to make some judgment about, is it a good rally or is it a poor rally? Turns out that the stock stalls again at the same point. So now I've got what could be a triple top. I don't know that. I just know it's stalled. Now I get a reaction that doesn't go down completely across the pattern. Charles Kirkpatrick calls that a shortfall. This is usually a tip-off that this pattern is a bullish pattern because this reaction was less than the previous ones. This is my favorite pattern to buy. I have a stock that's been in an uptrend, and now I have a sideways type correction this is a pattern that I'm expecting to come out on the upside. Might not, but that's what I'm expecting. So after this pullback and it turns up again, this is where I'm really excited about looking to buy the stock. If I have really good volume and volatility characteristics in here, widening daily ranges, close at the upper end, higher daily volume, I might even anticipate that breakout. But I would certainly buy the breakout in this pattern, and I would certainly look to buy a retest of the pattern. Why am I excited about this pattern? It's come after a lengthy advance, and the correction is sideways. It's showing relative strength, and the tip-off is a reaction that doesn't carry across the pattern. Often you get this kind of a pattern. This is, there's no time horizon on this, so we can't tell. In a stock that's been in, let's say, a dynamic uptrend for a couple of months, if this is a couple of weeks, it would be more. This pattern would be pretty damn powerful. As you go out a couple of weeks, if volume and volatility drop off right away, that's going to convince me that this is going to come out on the upside. I want to look to buy this stock as soon as it gives me new signals again. So how long it spends in here is a key. How big an advance it's had before is important. So before we can really make much of a judgment on this pattern, we need to know what the trend has been, how powerful it's been, and how long the pattern is in force. A powerful uptrend will pause very briefly. Volume and volatility will drop off right away. And what is that telling us? It's telling us that nobody wants to sell the stock. Right? We had some selling in here, and it stalled. But with the volume and volatility drying up, it's telling me that no one wants to sell it. It's going to come out of that pattern on the upside. Get ready to buy that breakout, or maybe even in anticipation of it. And again, it's a rectangle simply because we have a couple of highs and a couple of lows in the same area. You never see a perfect rectangle. All right. So, what's the difference between a head and shoulders and a double top and a triple top? Simply, we have three highs. Right in here at this point, it looks exactly like that last chart. Right. Now, this pattern looks different because we have more amplitude in it, and if this is over a number of months after a couple of years of advance, well, I'm going to be more suspicious. If it's just a few weeks, then I have a different attitude. So we have resistance met, support held, resistance met. So this reaction, we have a couple of rallies that failed now, not just one. We've had two failing rallies. So I'm going to be a little more suspicious on this reaction here. If we get any kind of volume and volatility increase on the downside, that's going to make me think it's probably going to break down. So if we've owned the stock for a long period of time, didn't do any selling in here, maybe you did, maybe you wanted to, maybe you didn't, doesn't matter. You want to sell some on the breakdown, sell some more on the rally, or an opportunity to go short. On all of these reversal patterns, if they take a number of months to form, there's always some kind of a rebound after it. The notion that right here, one day after the break, I missed it, I can't sell it now, it's down this much. Well, if we're talking 50 here and 60 here and 10 or 15 down here, yeah, no way. It's not about trying to sell the stock as close to the high as you can or buying it as close to the low. That's not what it's about. It's about having confidence in the trend, confidence in the reversal, and we're going to try to make some money. These patterns will help us preserve some of the profits, limit losses. It's not about catching the high and catching the low. The stock has gone from 20 to 80, and this is 70. and I end up selling it at 70 after having bought it maybe at 30 or something down here, hey, I made a lot of money. I'm not trying to, I wouldn't even pretend to be able to say we're going to try to sell it at the high. Selling it at near that high, if you're a trader and you've been trading it in this range, you have a neutral trend in here, fine. You do a little buying, do a little selling. But from an investment standpoint, what has happened before is going to determine how aggressive you're going to be buying or selling. And this is just the opposite. This can't be a bottom, of course, unless it came from up here somewhere. So we've had a decline. The terminology is important. You need to know what these terms mean. And entry means it has started the pattern. That's where the pattern begins. We don't know it at that point, after it moves for a while. Then we know that that's where it began. So we have a downtrend that stopped at this point. We have a rally in a downtrend. We have a reaction that holds a previous low. So the trend might be changing. Once it rallied on this leg of advance, the trend has changed. It's gone from down to neutral. It's a neutral trend, resistance held, support held. Looking at this rally, and now we got a breakout. So at this point, we now have an uptrend. We've gone from neutral to up because we've exceeded a previous resistance level. Just like on the downside, we might want to try to anticipate this. If you were lucky enough to do it, fine. If you didn't, you do some buying on the breakout. If you didn't know, if this happens very quickly, you don't get a chance. You don't want to buy it way above the base because why not? Why do I not want to buy the stock here? Well, because it might be a failure, right? I've always got to be concerned with containing risk. So at this point, all I know is I have an extended stock. I think the trend is up, but I don't know where that next reaction is going to hold. I don't know it until after it's done it. And so at this point, I'm going to wait for a pullback. When it gets down near that resistance line, do I buy it the first day I think it's hit that line? Probably not, because I'm looking for volume and volatility to give me a sign that this pullback is over, or it's not over. If we're seeing building volume and volatility in here, I'm not going to look for that to hold. I'm going to look for it to break. So. Again, we're calling it a triple bottom simply because it has three lows in the same area. If this low is down here, it'd look more like a head and shoulders pattern. Not going to change our tactics or our interpretation. Okay. Descending triangle. We have a stock that's had an advance over time, pull back in an uptrend, holds a support level, and we get a weaker rally. But it holds support. So at this point, I'm suspicious of this trend. Now, if this were a couple of weeks in an uptrend, I'm not concerned at all, especially volume and volatility coming down. But if we're talking about a number of months, this is a weaker rally, and we have another weaker rally. Now I'm beginning to think that this is a descending triangle. Equal bottoms, declining tops, sign that the buyers are getting used up. And at this point, of course, we know that the sellers are getting more aggressive. People that have owned the stock, maybe they did some selling, maybe they did some selling here, but something is changing. The rallies are getting weaker. And of course, we have a breakdown, follow through, throwback rally, pullback rally, and now we resume a downtrend. Everything else applies. We want to be analyzing the volume in here to get some insights. More than likely, you'll have lower volume here than you did here, and lower volume yet here. Highest volume in this pattern is almost always here. In fact, if it wasn't, I'd be suspicious that it's not a descending triangle. If we have higher volume on this leg up, probably not. So the volume is going to be important. It doesn't complete the pattern. It is not a breakdown until you violate support. Sell long stock here, short stock here. Now here's the same pattern, and goes the other way. We have the stock spin in an uptrend, reaction in an uptrend, little weaker rally. We hold support. Better rally in here. So it's better than this one, not as good as that one. So at this point, what do we have? Well, we have a rectangular pattern of sorts, and it's unclear at this point. We have a higher high, but not as high as that one. So if this is going to be continue to improve this pattern, this is a bullish sign. At this point, what we're saying is, well, if this is going to resolve positively, we should get a reaction that doesn't go back across the pattern to this previous support level. So this leg in here is going to be the tip-off. This is where we're going to be paying a lot of attention. In all likelihood, less volume and volatility than you had here. And right here, we're probably seeing it pick up again. This is a pattern that I'm interested in buying here. If it has the right volume profile, clearly you'll want to buy the breakout or a test of that breakout later, etc. So, once we have a descending triangle, resolve the other way. And all of these patterns, it's the end of the patterns that's important. Once when they first move into the pattern, it's never clear what's going to evolve out of it. But as the pattern progresses, then we start to get some clues. And of course, these are just line charts. There's no volume on them. We're just trying to give you the basic form of the pattern. But the volume and the volatility on a daily bar chart will be very important in our tactics on this pattern. Now, at this point, we have an uptrend. We have a reaction in an uptrend. Now we have a rally that fails at a previous resistance level. So at this point, this could be a double top. We don't know. Could be part of a big rectangle. We don't know that either. So all we know is we have resistance met and we're in a reaction. Now we have a higher low. So we had an equal high, sign of some weakness. Now we have a higher low, a sign of strength. So now, once I go through this leg, this pullback leg, now I've got an unresolved pattern that could go either way. So now I'm going to be paying more attention. Fails again at that previous resistance level. Not a good sign. It was improving in here, but still not clear. It's not clear till you break these lows. Okay, now I have a pattern of my third lower low. I've broken. I've had a higher low. Now I've broken that pattern and come back down to the bottom of the trend line. So at this point, I'm going from a strong pattern to an unresolved one, questionable one. Right in here, I'm now looking for this pattern to become a top because I have failed well below the highs of the range. I've failed at the resistance line. The support line becomes a resistance line when it's violated. So in here, you want to be looking to take some action on the sell or short side, depending on what that rally looks like. And of course, here you must do it when it actually breaks down out of the pattern. So, look like a double top, but we had rising lows, so we have an ascending triangle, which is a bullish pattern until it violates the parameters of the ascending triangle, which it does right here. Okay? There's a million variations of the patterns, and we go through it all because it's often not clear. It's nice when a stock is surging up or plunging down, but you're often in these kind of unresolved patterns. They're more important than the trends. In the trend, fine. You're long an uptrend, you're short a downtrend. But here, there's an opportunity building, and that's why I want to pay attention to it. Either we're going to get a breakout from a new base or break down from a new top. So it's when stocks stop trending that opportunities arise. All right. This is a short-term pattern, a symmetrical triangle. You're really going to see this over a long period of time. Stock has been in a dynamic uptrend for a couple of months, stops advancing for a couple of weeks, and then blows out on the upside. Very common pattern. Not the most common short-term continuation pattern, but a pretty common one. We have higher lows and lower highs. So it takes on the shape of a triangle. If it's these continuation patterns, like a symmetrical triangle, are rarely going to last more than 2 or 3 weeks. They're usually in dynamic advances. Stock is maybe up 50% or more, stalls for a bit. This leg of retracement is only a small portion of the whole move. Volume and volatility dry up immediately. The characteristic of a symmetrical triangle in an uptrend is big drop off in volume and volatility right away. You want to buy it here. And why is the pattern so important? Because we can buy it well below the high. Because we were resolving the triangle to the upside. And just like most other patterns, we get an opportunity for some kind of a test, and it runs up again. But I want to. This would be one of my favorite places to buy right here, because my risks aren't that great. I have this uptrend line here. Maybe not perfect, but if this is a symmetrical triangle, these are measuring patterns. Symmetrical triangle is going to occur in the middle of a leg. We have a stock that's gone from, let's say, 20 to 30 pretty rapidly, and then we go through some kind of pause, and then go again. This can be a triangle or a pennant or a flag. We'll get into those other things later, but we can duplicate that leg. This pattern normally means you're going to duplicate that leg. So I got a $40 target here. They occur in the middle of legs, up or down. Charlie put this in the book, Charles Kirkpatrick. You have a broadening pattern and a resolution on the upside. I've never seen this. I guess he has because it's in the book. This pattern is almost always bearish, in my opinion. But, right, we have a broadening pattern, meaning that we have lower lows and higher highs. Broadening pattern after an advance. I think it's usually negative. But the point is, at this point, we don't know, and it breaks out. It goes above the resistance line. So even if I thought this might be some kind of a top, well, it isn't once it breaks out and throwback rally. Broadening patterns usually have building volume. Tip-off to this as a bearish pattern will be building volume through the pattern. Higher volume on this down leg than this one, if this is going to be a bearish pattern. Now, breaking out on the upside, in all likelihood, this volume is probably bigger than this one. That could be your tip-off. But a broadening pattern means we have higher highs and higher lows in this big range. These can last for a long period of time. If it's just a few weeks after an advance, probably a bullish pattern. But if this is a few months, then I'd be beginning to think that it's probably going to go the other way from this pattern. Broadening patterns are, if they have the right volume profile, after a big advance, can be deadly. And here is what can happen. We have a broadening pattern and a narrowing pattern. Here we have a broadening pattern, and it doesn't go anywhere. Now we have a narrowing pattern. It turns out to look something like a diamond because we have lower lows and higher highs on this side of it, then it starts to go the other way again. I haven't seen this since 1937, this pattern actually, but it's pretty damn rare, but it's very bearish. It would occur over a long period of time. It's usually a big reversal after a huge move. While it's in this pattern, we draw our trend lines, our support lines, and our resistance lines. I'd be expecting this to break to the downside, but until it does, it's not clear. So right in here, this is something I want to sell. Maybe not the greatest short, we're down a fair amount, but we're still above that low, so we can anticipate a violation of that support at some point. And here's the throwback rally to sell again. So a diamond simply means a broadening pattern followed by a narrowing pattern. In all likelihood, you'll have weak volume here. You might have comparable volume on these rallies, but a tip-off is going to be in the volume in the right half of the diamond. Maybe bigger volume here, weaker volume here, pick up in volume here again. Might be comparable on these rallies. But again, it's the second, as the pattern is finishing or winding up and completing is when we're going to get the tip-off. We might get the tip-off to whether it's a reversal pattern or not. Diamonds are rare. Usually over many months after a big advance. I can't recall ever seeing one really short-term. But okay. A wedge looks like a triangle, but it's not a triangle. This is the question that lots of people always miss on the tests. The stock has been in an uptrend and then goes through some kind of pause here. What's the difference in those two patterns when you look at them? Anybody see the difference in those patterns? They look kind of the same, but there's a very important distinction. Yeah. A triangle has converging support and resistance lines. It has declining support line and a declining resistance line and a rising support line. That's what a triangle is. This has both lines are rising, but they're converging. That's what makes it a wedge. And even though that might sound silly and minutia, the difference is important. This pattern is almost always bullish. This one is almost always bearish. Why? Well, I don't know. Here we have rallies that are making new highs, but they're making highs very marginally, and they last a while, and they usually lead to sharp drops. here we have one, we have an uptrend and a reaction in an uptrend. Now this wedge is occurring under that peak. It's labeled climax peak because in all likelihood we had very high volume and volatility on the upside and on the downside. Climax means high volume and high volatility up, followed by high volume and high volatility down. A climax peak, that's what that means. And so now we're starting to come back, and we come back in this zigzag fashion with rising support line and rising resistance line. If I saw this pattern developing, man, I would be looking for it to stall under that previous peak. Now, of course, this is almost perfect in this case, but at this point, where I've broken the lower end of the wedge, I really want to look to sell this stock because these patterns usually lead to very sharp declines. A bearish wedge, it's a bearish wedge because it's a rising wedge in an uptrend. A bullish wedge would be a falling wedge in a downtrend. Okay? It is a bearish wedge because it's rising in an uptrend. Seems like minutia, but the difference in my experience is really important. And to complete the thought, we break the support line, another throwback rally, and of course it has a bigger rally than you might expect because the wedge is a witchy kind of a pattern. But up in here, I'm really looking to sell the stock because I've got a couple of failing rallies. I have what looks like a wedge. So the volume and volatility profile right in here are going to be really important. I mean, I want to sell this thing or short this thing as soon as I see some volatility or volume on the downside. Because if it's a wedge, which it looks like it's a wedge, it's going to go back through the whole pattern very abruptly. Lasts longer than a triangle or pennant or what have you. It probably takes twice as long or more. In uptrends, flags and pennants last 2 or 3 weeks. A wedge could last a month or two. Here's the same thing on the inverse. It's a falling wedge in a downtrend is a bullish pattern. Again, we have probably a climactic low here. Not necessarily, but probably. High volume, high volatility down. High volume, high volatility up. That's what a climax bottom is. And of course, it usually produces a very sharp rally. It's nice to catch these things. The trouble is they're almost impossible to catch. We have a stock that's probably been getting beaten up for months and then has a very sharp sell-off at the end. By the time you realize the sell-off is over, you've had a sharp rally. Stock goes from 30 to 3, bounces to 6. Hey, it's 100%. The trouble is it's usually in a couple of days, almost impossible to catch. That's what some of the banks did recently. In any case, you don't have to. We're going to come back down, and here we've got a declining resistance line and a declining support line. So as this thing starts down, I'm going to be confident that climax should be good support. So as I approach it, I want to be looking for signs to buy the stock. And here we break a downtrend line. Here we get a test, usually back near that line. The resistance line becomes a support line after it's broken, and now we turn around and move back up again. For those of you who read Investors Daily, I don't know if you do, you should. It's a great paper for traders. William O'Neill loves this pattern. The editor of Investors Daily. This is what he calls a cup and handle. It's my favorite pattern. We have a rounding bottom. This usually takes many months. It's not. You're not going to see this in weeks. It's not a rounding bottom unless it's over months. And we might see high volume here or diminishing volume. Doesn't really matter. But we get a rally over time that stalls at some resistance level. Now, we weren't able to buy this stock or play it because it really didn't give us much of a clue down here. There was no bottom, and now we have a big rally. It would have been nice to catch it here, but we probably didn't really get much opportunity. But this takes a number of months, and now we get a pullback that's only a partial retracement of this last leg up, and it starts up again. I'm looking to buy this stock in this leg, in this period, in this area here. If it shows me good volume and volatility profile, definitely want to buy the breakout because this base has a big count. So buy it here. You know, we got to pull back, throw back to the breakout point. I'll buy some more. But what does this mean? This handle part of the pattern? It means that we've had a big run, and we are correcting that big run with basically with a modest pullback. Sometimes it's just even smaller yet. It means that it's shown relative strength on this pullback. Big change, major decline, built a base, and now it's able to correct with just a minor pullback. So there's a big change in psychology toward this stock. You know, all those sellers are gone. Now we have more aggressive buyers in here. So it turns out to look like a cup and handle. A big rounding bottom followed by a small setback at the end. Obviously, this is when the pattern is completed, but if it gives you insights in here that are favorable, I'd buy in anticipation of a breakout. But you don't have to buy in anticipation of the breakout because we can buy the breakout and buy the test because if this is a cup and handle, stock's going up here. Yeah, there's going to be plenty of room on the upside. Here's our head and shoulders pattern again, which I started with. And all the information is there. We have an uptrend. You know, at this point, the only tip-off that this might not be a durable uptrend is the volume on this leg is below that leg. If that's the case, I'm suspicious. But it's an uptrend. Trend is up. You know, it's not giving me any good reason to sell it. At this point, this reaction has broken an uptrend line. There's an uptrend line that's been broken in here. So I've broken an uptrend, held support. Not at this, even at this point, this implies some weakness because I've had a bigger correction, but I haven't broken any kind of support level of consequence, so I'm not going to get all that bearish. But I am going to pay special attention to this rally because if this rally stalls below that peak, or near where the left shoulder is, then it's going to begin to look like a top. Don't want to anticipate a head and shoulders pattern because at this juncture I have some kind of a trading range pattern unless there's something really negative about the volume and volatility in here. You wait for it to break down because you almost always get this throwback rally. And it is a reversal pattern of consequence. You're not going to see a stock go from 10 to 20 and then build a head and shoulders pattern between 20 and 25. It's a major reversal pattern. It's going to come after a much more lengthy move, which means there's a lot to correct. So that's why it's wrong to anticipate it. It's unnecessary to anticipate it because at this point it probably means we're going to have a pretty substantial decline. Again, you need to have seen a big advance beforehand. The bigger the advance and the longer it takes to build this pattern, the more likely it's a major reversal for a substantial decline. And typically, you'll get highest volume here, less volume here, less volume here. On these sell-offs, maybe nothing special, and maybe not even in here. The tip-off on a head and shoulders pattern is diminishing volume on the rallies. Not really much clue about the volume on reactions until you break. Frequently, at this point, there'll be a big pickup in volume. This is the opposite again, exactly the same. Big decline has to have come from a lot higher to be a bottom. We have a downtrending pattern, a rally that breaks a downtrend. There's a downtrend line in here that's been broken, and a shallower correction. I'm going to be paying a lot of attention to the volume and volatility on this rally, and if it's building, if the volume on this leg is higher than this leg, again, it's not exactly the inverse of a top. Top, the volume diminishes through the whole thing. Here, you might not see this might be the highest, this might be higher at this point, but you definitely want to see higher. This might be lower at the final low, but what I want to see is building volume on this leg for sure. Breakout, test, advance. Head and shoulders patterns are measuring patterns. All of these patterns are of some value in measurement. They're just guides, but you need to have some idea where a stock might be going. We have an advance here. Okay, a stock that's come from single digits, maybe 10, going to 75, and measures about from 60 to 75 in the head and shoulders pattern. A minimum count on the downside would be 60 minus 75, or minus 15, or a $45 count. The breadth of the pattern is an estimate, a rough estimate of what the potential might be. Could be even more. This would also be true on a double top, triple top. You take a look at the breadth of the pattern, subtract the neckline from the top, and that's how you get your target. Continuation patterns. To repeat that, the counts from a continuation pattern is they tend to be in the middle of legs. So if I've gone from 20 to 30, and then I go through some kind of a triangle, if this is a powerful leg here, big volume and volatility, I'm going to look for a $40 target. So these measure by being in the middle of legs, these continuation patterns. Reversal patterns, it's the breadth of the pattern. And here's some schematics of flags and pennants. A pennant is a triangle, and a flag is a little rectangle. But what tips off the patterns to be bullish patterns and uptrends is, first of all, they're only going to occur in powerful moves. Stocks in a dynamic trend pauses for a bit. Dynamic trend pauses for a bit. The volume and volatility drop off right away, and these patterns last just 2 or 3 weeks, and you blast out again. I don't like the way this one is drawn here. You don't expect the pattern to go out to the apex. You're expecting it to resolve sort of 2/3 of the way along. So this is drawn a little different than I would draw it. Once you get out more than 3/4 of the way through the pattern, you get too close to it, they tend to abort more than not. So I'm looking for these patterns these triangle patterns or pennants to be resolved about 2/3 to 3/4 of the way to the apex. Powerful patterns. They're temporary pauses in dynamic trends, and the tip-off will be a big drop in volume and volatility right away. And the patterns are really useful to trade because your risks are pretty contained, because these are small patterns. Buy it here, stop it here. Here, let me just see what we got on the PNFs on the volume. Okay. We've been looking at bar charts and line charts. There's quite a few examples of point and figure charts in the text. And we talked about this when we were talking about chart types. We're going to see the same thing. This is a rectangular pattern that would appear on a bar chart or a line chart. The support and resistance levels jump out at you on these point and figure charts. That's what makes them useful to look at. We don't really want to anticipate breakouts on bar charts that often, and we never want to do it on PNFs. In other words, this pattern is not a base until you get this tick. Okay? So you can call it an advantage or a disadvantage, but this is the breakout tick. Now I want to be a buyer. And of course, you have a rally and a throwback and a test, the same thing. Point and figure charts are useful in getting some kind of potential as well. I don't know what the stock has done in here. Maybe it's come down a lot. Maybe it hasn't. But counting across this base gives us some idea of potential on the upside. So what we do is we look at the row with the most number of X's and add that to the bottom of the pattern for a conservative account, or the top of the pattern in an aggressive account. And what Ken Tower showed us is you can do this with a protractor by just swinging it up and measuring it up in here. But basically we're counting across the base, adding it to the breakout, kind of an aggressive count, or adding it to the bottom of the base, kind of a conservative account. And you just look for the row with the most number of X's to get your potential. And Charlie Kirkpatrick was saying that he is anticipating that this pattern is going to be a base because more of the work is at the low end than the upper end. See? This is called work on a point and figure chart, or backing and filling. And we've had these rallies up in here. So there's not a lot of resistance at the upper end of this pattern because there's only a couple of X's near the upper end of the pattern. Meanwhile, there's a lot of them down below. So the pattern is tipping us off that it's more likely a base than not because of that. But until it breaks out, it isn't a base. Okay, we're not going to belabor all this to death. Triangle looks just the same on a point and figure chart. We may be able to anticipate a breakout on a bar chart. Can't do it on a PNF because we don't know what the volume or the intraday volatility looks like. Doesn't matter though if you believe in the methodology. You want to buy the breakout tick. Again, especially if there's been a long, powerful move here, and you buy the breakout. Just another example of the methodology and how you count it. Look for the row with the most number of X's. And here we can count these X's and add it to this point, and this is our target. And if you have a protractor, you can do that by measuring it as well. I'm not going to be overly belaboring some of the terminology in the point and figure chart. This fulcrum bottom just means there's a couple of bottoms, okay? A couple of tests. The notion of trend lines is the same on a PNF as it is on a bar chart. These charts are using the three box reversal methodology. So this trend line is drawn simply by drawing a 45-degree line to the downside from the top of the column. That's how this line is plotted. It's not connecting two highs like this high and this high. This is a methodology that you may or may not agree with. I don't use it, but that's how this trend line is drawn. The methodology is you draw a 45-degree line from the highest high, from the lowest low, and plot the trends that way. Only on a three-box reversal chart do you do that. If it was 1 point by 1 point, you don't do it. Here we're counting a little consolidation, same methodology. One of the neat aspects of a point and figure chart is that you don't need a lot of a pattern to get some useful information. Here we have a row of X's, a column of X's, a column of O's, another column of X's, and a higher X. So that is a breakout of some consequence. Even if this occurred in 1 day or 1 week or what have you, without knowing anything else, that is a buy signal of sorts, and this is a sell signal of sorts. And here the difference is we have a declining column, another declining column that goes to a higher level. So we have rising bottoms, slightly more bullish pattern, declining tops, slightly more negative pattern. We can do, just as we had double tops and triple tops on bar charts, do the same thing on a P&F. Triple top breakout, triple bottom breakdown. Here we have a rising column, another rising column, and a third, all of these to higher levels. And so that's another buy signal of sorts on a point and figure chart, because this is a breakout. Just as this one was, this one is even more powerful because it's gone above 2 previous rally highs. And this is the inverse of that. And here we're just showing example of more backing and filling in the pattern, more columns. And so as more columns develop, it becomes more significant. The breakout or breakdown becomes more significant. And we can identify triangles on a P&F just like you can on a bar chart. Here we have a resistance line and a support line, and we break the resistance line, complete the triangle positively, and vice versa on the downside. I'm not going to belabor all of these to death. Here's one that's a pattern that might be hard to identify on a bar chart. We have a stock that built a big top, had a huge decline. We don't know how long this is taking, but a huge decline. On a bar chart, this may look like a sharp rally from an oversold position and not really tell us much. But on a 3-point reversal point and figure chart, once we get a 3-point reversal, we have a trend change. And so regardless of how long it took for this pattern to develop, the point and figure methodology would say, I'm going to buy some here because I have broken that downtrend. I have 3 X's, which is the minimum I need for an uptrend. The trend is up. False breakouts and false breakdowns are a little maybe easier to identify in a point and figure chart than a bar chart. Here we have a stock in an uptrend, little pullback, rally that fails. So we're still in a sort of a consolidation. And at this point, we're still in a consolidation. Here I have a breakdown. Turns out to be a false breakdown. Do we know it at this point? No, we don't. depending on your position in the stock, maybe you did some selling here on that breakdown point. Regardless, you got to buy it back right here because it was a false break. How do we know it's a false break? Because we got a 3-point reversal to the upside. On a bar chart, this may appear as very big volume down and back. Light volume in here, then a shakeout, and this might occur with broadening daily ranges and high volume. Same thing up. So on a bar chart, to see that configuration probably means you've got some intraday volume and volatility, or interday volume and volatility. Okay, part of patterns, a gap is a blank pattern. All right, we talked about gaps in the glossary. A gap is when you have no overlay between one day and the next. All right. Stock closes. Normally, when you get a downside gap like this, it's probably going to occur from a very poor close one day. Next day opens at prices it never traded at the day before, and we go down. Gaps are important because they indicate a big change in the supply-demand situation for that stock overnight. Obviously, this is a daily bar chart. So stock was acting poorly one day and opens at considerably lower the next day. Frequently, they're news related. Does it mean they're unimportant because the news is out? No. What the stock does in response to the news is what's important. So if there was, if the stock closed here and there was bad news and it opened in this range the next day, well, it wasn't bad news or it was discounted. So you never want to say the stock ignored bad news or why didn't it go down because there was bad news. The market is always the final arbiter on that. Whatever happened in here was bad news, whether you thought so or not. And there are three kinds of gaps. Let me just see how they show up here. Yeah. Let's do it this way. We have a stock that's been in some kind of a trading range and gap. This is a pattern that's been in force for months, and we get a gap in here. That's probably 99% or whatever a breakaway gap, meaning that it is initiating a new trend. A breakaway gap initiates a trend. We've had a neutral trend, and now we have an uptrend. Powerful way to complete the base. Usually very big volume and very big volatility in here, and we're probably going to go up at least this much right away. Breakaway gap. The notion that gaps are always filled, you hear that old wives' tale around, but that's bunk. I mean, some gaps are filled right away, some are never filled. Breakaway gap may never be filled. This could be a multi-year base pattern. We're off on a new uptrend. So breakaway gaps are often never filled. So usually not filled. If we have a stock that's been in an uptrend for a while and then gaps, and here, that's called a measuring gap. It's occurring in the middle. It's occurring in a trend. These gaps are called measuring gaps because we've had a leg of advance, get a gap, probably going to duplicate that leg up here. These gaps can be filled. Measuring gaps are filled some of the time. I wouldn't say most of the time, but often measuring gaps can be filled. Breakaway gaps almost never. Measuring gaps often. We have a stock that's been in an uptrend for a long time. Gaps. This is an exhaustion gap. which ends a move. Exhaustion gaps are always filled. By definition, they're filled almost immediately, or sometimes the very next day. So how do you know it's an exhaustion gap? How do you know it's a breakaway? How do you know it's a measuring gap? You don't know immediately. Well, we know that's not a breakaway gap. It's been in an uptrend. Is it a measuring gap? Well, it depends. We don't know that immediately. If the stock the next day gaps down, we have two gaps, gap up and gap down. That creates what we call a little island here, an island reversal to the downside. Very negative. You get a stock that's been in an uptrend and gaps and fuzzes around for a while and then gaps down. So we end up with two gaps about in the same area. That's leaving this pattern sort of all by itself, isolated. We call it an island, usually very bearish. In other words, if we get a gap and it doesn't really go anywhere, sometimes this can break down right away, sometimes it takes a while, but an exhaustion gap is filled all the time. By definition, that's what makes it an exhaustion gap. You don't necessarily know the day it happens, but you'll know pretty soon, because if this upside gap is a bullish pattern, stock is going to move ahead right away. And as soon as and maybe we don't even know in here. Maybe we don't know yet. Once it goes back into the pattern, especially if there's another gap, now we know that it's an exhaustion gap, and this is an important top. Gap up, gap down. So breakaway gaps almost never filled. Measuring gaps filled a lot, some of the time, often. Exhaustion gaps always. So it depends on where it occurs and what happens. You might not immediately know. Breakaways, you'll know, because they start moves, and they're usually pretty dynamic. We have some tactics suggested in the text on how to react, how to buy and sell based on gaps. And here is an upside gap or a breakaway. We're trying to buy this stock. It's consolidating after the breakaway gap. If I've bought the stock on the gap, well, I'm assuming it's a breakaway. That means it shouldn't be filled. So this is my risk point right in here. That's my stop point. Once I surge back up, now I raise my stop to the low end of the consolidation. I can, this line could have been drawn right through here. Actually, it doesn't really matter. But I have a consolidation, have an upside gap, big breakaway. I know I want to own that stock. I'm doing a little buying in this consolidation. Once it goes again, that's confirming that it's an important breakaway, and I'm going to add to it again. Now this illustration is to point out the difference between a gap and something that looks like a gap that's not a gap. If you watch CNBC, anytime a stock opens up or down, they talk about it gapping up or gapping down. Well, that's not a gap necessarily. It's only a gap if there's no overlay in the price action from one day to the next. And you don't know it, obviously, till the full trading day is completed. Here's a stock that closed at this level yesterday. Today opens down here. Well, possibility of a gap. But during the day, it rallies up back into the pattern, fills it, there's no gap, closes down here. Bearish pattern, but not a downside gap. So I would avoid even the notion of talking about an opening gap, because you can't tell on the opening if it's going to be a gap. The expression I hate after a gap to the downside, Charlie Kirkpatrick tells about a dead cat bounce, another dead cat bounce. Dead cats don't bounce, so to me it's a stupid expression, but in any case, he means a poor rally. You ever drop a dead cat? It does not bounce. in any case, the observation he's making is that following the gap, you might get some consolidation rather than an immediate follow-through, or you might get a little lift. But once you get this downside gap, I'm respecting that downside gap. I'm expecting that stock to continue to move down. Maybe not that day or 2 days later, but soon I'm expecting it to move down. At this point, depending on how long the stock has been going down, if it's been going down for forever, this could be an exhaustion gap. It could be. If it's an exhaustion gap, though, it will get filled pretty quickly. So, all right, so climax on the downside, could be an exhaustion gap. Feeble rally, doesn't fill the gap, starts to sag off again. Already in here, I know that this is not an exhaustion gap. And it's probably going to resume the decline or at least go through some lengthy basing. There are some very small patterns that can be discussed, and this is a 2-day pattern. Outside days are often reversal patterns, and inside days are often continuation patterns. We have a stock that's been in some kind of an uptrend, and then one day does this. An inside day, meaning that the low today is higher than yesterday's low, the high today is lower than yesterday's high. So all the trading is within the bounds of yesterday. Now, more than likely, the volume is going to drop from this day to this day because this is a consolidating pattern. If the volume is higher, I'm going to forget that. But if volume is lower and if it's an inside day, I want to buy that stock because it's probably in some kind of a consolidation. On the other hand, if we have an outside day where the high is higher than the day before and the low is lower, and there's a volume pickup, that's probably a reversal pattern. So outside days tend, and both are true on the downside as well. And so here I have a wider range, higher high, lower low, usually bigger volume, some kind of a top. And the bigger the range and the bigger the volume, the more significance to the pattern. And the bigger these distances are, the more significant the pattern. So inside days, consolidations, you expect a continuation of the trend. Outside days, usually reversal patterns. And he has some specific tactics about how you would buy and where you'd put a stop. For the purpose of this course, I'm not interested in those things. It's really minutia, but what I said is what I want you to know. And this is some candlestick methodology applied to bar charts. We can forget that as well. I don't want to get involved with that. Same thing here. Landry, we can skip that. I'm not interested in that. I don't know why he goes through these candlestick candle chart terminology with bar charts, but we'll skip all of that. This is also from a candle chart methodology. This narrow range bar, but it's really covered by what I said before: inside day and outside days. This little bar is really an inside day, and if you're in an uptrend and consolidating, and the range has gotten smaller and smaller. Well, what is this? Probably a little triangle, right? Probably a favorable pattern. That's why it's a buy. He calls it narrow range bar. Part of a little continuation pattern is what it is. All right, there's a few candle charts that you should know. And the Harami is useful because they're like inside days, but they are reversal patterns. And the difference between a simple inside day and a Harami is that you have different color candles, and it can be either way. You can have a big white one and a small inside black one, or vice versa. But if this pattern occurs if this occurs after an advance, it's probably some kind of a top. If it occurs after a decline, probably some kind of a bottom. But the difference between an inside day, which is a continuation pattern, and this is that they are different colors. Favorable to unfavorable, white to black, unfavorable to favorable, black to white. So Harami is useful in knowing that. And we're just adding a third day to that previous chart. So if this is a bearish pattern, I'm expecting a negative day, and this is sort of the confirming day, if you will. Hanging man and a hammer look the same. The difference is where they occur in the pattern. So if I have, it doesn't matter whether they're white or black either. It can be a top. If it's after an advance, if we have a small candle at the upper end of the range, then it's called a hanging man. It can be white or black. After an advance, with the pattern occurring at the top of the range, hanging man. If it occurs in a downtrend, it'll look the same, but it'll be in a downtrend, and it can be white or black in a downtrend too. So where it occurs is where it's useful. And what's happening is that you've got a big change in the trend. So you have a stock that's been in an uptrend, and now opens up here one day, has a big reaction, closes off the low, but down on the day. So sign of selling in the stock, the opposite if it occurs near a decline. But either pattern, this could be a top or a bottom, this could be a top or a bottom. Depends on where it occurs in the pattern. The evening star and morning star, here what you have is a small body in the middle of the range. So if we've had an uptrend and then we get this small real body, it can be white or black, but following an advance, if we've had big candles on the way up and now we get a small one in the middle of the range, could be a reversal, you don't know it, this is the confirming day, the third day. And the opposite is true at a bottom. And so the tip-off is, after a decline, you've probably had a lot of dark candles, we get a small one in the middle of its range. Call it a morning star at the bottom, they call it an evening star at the top. Japanese are very colorful, evening star is the end and morning is the beginning. So, okay. I don't want you to learn a couple of dozen candle names. That's not important. You do the few candle charts that we show that I showed you. You should know those. Okay, so just to sum up, you can't have a reversal pattern unless there's something to reverse. So don't start looking for head and shoulders bottoms in stocks that haven't gone down, right? So you need something to reverse. Reversal patterns take a lot of time to develop, and the longer the advance or decline a stock has had, the longer a reversal pattern is going to take. And so reversal patterns are going to take the form of head and shoulders, or double tops, or triple tops, or head and shoulders bottoms, or double bottoms, or triple bottoms over months, usually following a year or two or more of move beforehand. The volume associated with any pattern is very important. Continuation patterns usually last just a few weeks. The powerful ones, pennants, flags, pennants and flags, very short-lived. You can have more lengthy patterns that are continuation patterns, like a rectangle can occur in the middle of a trend. It's unusual, though. Most continuation patterns are going to be measured in a couple of weeks, 2 or 3 weeks, and the tip-off will be volume and volatility diminishes very quickly. And know the difference between a wedge and a triangle. You know, in a triangle or a pennant, they slope against the trend. The resistance line will be declining in an uptrend, and sometimes the support line will be flat. Sometimes the support line will be declining. A flag, both lines decline, but a wedge is different. A wedge will move in the direction of the trend. So a bearish wedge will have a rising resistance line and a rising support line. It usually lasts a lot longer than a flag or a pennant. Sometimes they can last for several months. Wedges often follow climactic lows, climactic bottoms. Okay, I guess that's it. So the time is important, the volume is important, the volatility is important.